Well, good afternoon. Hey, it is Shooter. Hey, we are just going to go over some Fibonacci extensions and how that relates to Elliott wave. Of course, at the end of our presentation, please do review our disclosure. Okay, now what we're looking at is a weekly view of the SPY ETF. Now, really quick, just to recap, we have two types of waves in Elliott wave, and each wave, whether it be a motive wave, which is an uptrend, or a corrective, has different Fibonacci levels that occur, or the most likely outcome based on the breadth of those legs. So, from measuring a Fibonacci extension, let me just start off and explain the difference. Mr. Market, when I say Mr. Market, that's everyone else. That's not me. Okay. And in Mr. Market, we have commercials and then we have retail investors. And to be very candid, no matter how much we would like to believe that retail will ever be big enough to move the needle, they won't, because they just don't have deep enough pockets. So what I just thrown up while I was chatting there is a single measuring Fibonacci retracement or extension tool, depending on which way you use it. And simply you measure your low and your high, and then it's going to give you Fibonacci levels. Now, the 50% back that I talk a lot about is because I view this in two different ways. And let me drop in our bullish Fibonacci extension and explain from there. The way the market looks at this, we have commercials who are looking for the 78.6 and retail is looking for the 61.8, and I'm looking for the 50% back. All right. So now let me just back out of these for a second. Most of the time in my work, you're going to see me measure the cycle. And when I say cycle, trough, peak, trough. So I'm measuring the cycle of the wave. So, I want to look, because really you can use any wave degree. Now, wave degree, real simple, is we have, super cycle, grand super cycle, primary wave, intermediate wave. Most of my work focuses between the cycle, super cycle, primary, and intermediate wave as far as what I put on my chart. So you always want to look at your largest wave first, and then I want to use my golden box extension, which basically is a version of Fibonacci extensions that just allows me to focus on a specific point. So once I get my primary wave set up, which real simply is a primary wave degree or above, and another wave crosses that intersection. So for example, where we have this cycle wave A, we have nothing else that crosses that wave intersection that I'm interested in, because I want it to be an intermediate wave or above. So once we have that primary wave set up, initially, my first target is going to be the 50% back. So I'm looking for that 554.55 just from measuring that cycle. Now, obviously, you can drill down a little bit further, in the scenario where you're stepping waves, so let's go down to the cycle wave for a second, and let's measure our cycle wave 1 and our cycle wave 2, and we get a little tighter scenario. 464.88 is what we would be looking for in our cycle wave 3 as far as a move. And obviously we went substantially above that. Same scenario if we step down even further in time and measure our primary wave in a similar way. So we're going to measure our primary wave 1 and our 2 in a bullish phase, and then we're going to look for our golden box extension to the upside. Now, sometimes you have some confluence in those measurements, but they're usually off quite a little bit when you measure a primary wave or an intermediate wave, primary wave, cycle wave, or a super cycle wave. Reason being is because you're really measuring different durations in time. So the thesis of the golden box is that, target 1 is pretty much a given. We're going to fall somewhere in this golden box between the 382 and the 618. I would be surprised if it falls in less than 90% of the time in that box on an extension. Same case as far as a reach. So what we want to do is trade our levels from here, basically take some fundamental technical analysis and add it to Fibonacci extensions and Elliott wave and really determine when we're right and when we're wrong. So the idea really is when you enter a position is know when you're wrong. You want a line, draw in the sand. Now, typically, what I like to do is cut half my position once my stop gets hit. However, it really depends on my P&L for the week. If I'm having a weak quarter, I don't want to hold too much unless it's running. I want the winners in play. The rest of it is I call the fat and the move. I don't want to hold those. I want to trim down to my core positions that are constantly putting in higher highs and lower lows, excuse me. So we're doing this step up. Higher high, higher low. higher high, higher low, higher high, higher low, et cetera, as we continually move up the scale. So once we close above that 78.6, then my target moves up to my second golden box, which is the 50%. Now, quite often on the second box, it's much shallower than the first leg, so you really want to watch your breath. You want to watch your arc, your slope, in what wave degree you actually have. And one thing that I like to use for that is a regression with a standard deviation on there, because it really helps you identify where your channel is, because your legs move in a channel. If you're in an impulse leg and your primary wave 2 put in the low of the channel, it's not likely you're going to break below there unless it becomes a leading diagonal or an ending diagonal. And in every motive wave, which is the uptrend, you have 3 types of waves. You have your impulse leg, which really has uniformity between your retrace on wave 2 and wave 4, or you have a leading diagonal, which is a broader 2 and a slenderer 1, or a ending diagonal where you have a broader 4 and a slenderer 2. That really is the only difference in those waves. And ultimately, what the waves are measuring is the euphoria of buyers and sellers, and what I like to refer to as FOMO, or FOL, fear of missing out, or FOL, fear of loss. And as we've seen, for example, this month ASML, it brought down the entire market. Everybody was repricing semis, so of course that does occur. But back to the main question about Fibonacci extensions, the 50% back is either the retracement level from that measurement, depending on how I've measured that level, or the correction, the retracement. For example, at wave 3, 50% back, once we put in our 598.73 in the SPY, I'm looking for a retrace of 6728. Now, I will say this, with the exception of this leg, most of the retraces that we've seen in the SPY have been shallow in internal waves. So the 4 could definitely be shallow. We could drop around the 60 or the 382 fib around 577.76. But again, if we throw in our RSI 8 period, we should be able to see some type of divergence in that leg. Just like, for example, on this leg up, our peak RSI was on the candle before our high. Our peak RSI was on the candle before our high. I'm using a weekly chart. Now, on our downside, our peak RSI was on our low. The peak RSI was on our low on our second candle in that trend. And that quite often is the case to the downside, unless we're putting in a bearish leg. And a bearish leg will reverse, and we will have confirmation. We have clear divergence on the bottom. So, even though this, difficulty, the challenge is really guessing when you're done, because your bottom, typically you have what I refer to as mounds that occur. So these humps that occur in RSI, which are the pushes that you see in these legs, right? And the challenging part in a mound is your final leg does not necessarily have your divergence. See, for example, our final down leg did not have clear confirmation and divergence. And be very candid, this entire leg, this corrective ABC, didn't have a confirmed low. It had divergence, but not a confirmed low like we had back in March. So that was just a quick review. Hopefully that was helpful, folks. Great trading. Until next time.